In this video we're going to look at the difference between what is meant by an expansionary stance and why that's different to just a simple loosening of monetary policy, and the difference between a contractionary stance and a tightening of monetary policy. Because it's actually possible that the RBA might tighten monetary policy but it not actually implement a contractionary stance. So loosening of monetary policy and expansionary monetary policy are also not the same thing. Before we get on to that, I did mention in the last video that there's a bigger gap now between the official cash rate and the standard variable mortgage. As you can see in this graph, you can see the difference is much bigger in 2014 than it was back in 2004. And a big part of that is because the banks aren't passing on the decrease in the cash rate, and that not the full decrease, and that's mainly because of the higher funding costs from borrowing from overseas. A couple of things. So, first of all, expansionary monetary policy is not the same as a loosening of monetary policy. So we refer to expansionary monetary policy is when the cash rate is low enough to stimulate aggregate demand and increase inflationary pressures. At the moment, we generally refer to an expansionary monetary policy is when the cash rate is below 3.5%. So any time that the cash rate is below 3.5%, we generally refer to that as an expansionary monetary policy stance. So basically, monetary policy can still be expansionary without a loosening of policy. So, for example, if our economy was growing really strongly, and the RBA decided to keep the interest rates the same, that would be still considered to be expansionary monetary policy, provided it was below 3.5%. But it wouldn't be a loosening of monetary policy because they haven't actually changed the cash rate. So if the monetary policy stays at a low interest rate without them actually changing it, or the cash rate remains low and low enough to be expanding economic activity, it's still referred to as expansionary monetary policy or an accommodative stance of monetary policy. So the RBA don't actually have to loosen monetary policy for it to be expansionary. The RBA can be expansionary and lift aggregate demand even though a tightening of monetary policy exists. So for example, if the economy is growing really fast and the RBA increase interest rates but not at a rate fast enough to slow the economy down, then it would still be considered expansionary. So in 2009 and 2010, the economy was growing quite fast and the cash rate was increased from 3% to 4.25%, but it was still considered a relatively expansionary stance because the interest rates weren't high enough to be slowing down the overall level of economic growth. Contractionary monetary policy is when we set the target cash rate high enough to lower aggregate demand and reduce inflationary pressures. At the moment, this is considered when the cash rate is generally above 3.5%, it's considered to be contractionary. And that's constantly changing what that cash rate was, and it was different back in 2009, 2010, when I talked about here it still being 4.25% as expansionary. So at the moment, if the cash rate's above 3.5%, it's considered to be a more contractionary stance. The RBA can be more restrictive without actually tightening monetary policy. So if economic growth was going really slowly or we were entering a recession and the RBA decided to keep the cash rate the same, we would generally refer to that as being less accommodative or contractionary as well, because they're not trying to decreasing the cash rate by enough to stimulate economic growth. Another example, in 2008, just after the GFC, when the cash rate fell from 7.25% to 6%, that wasn't enough to try and pick up economic activity, and it was still considered to be a contractionary monetary policy. So, for example, expansionary monetary policy not the same as a loosening. It can still be expansionary if they're increasing the cash rate, provided it is still low enough to be stimulating growth, and it can still be expansionary if they keep the cash rate the same. Neutral policy, when monetary policy is either being expansionary or restrictive and the cash rate is at its normal rate, we generally consider the cash rate at around 3.5% to be considered monetary policy neutrality. And that's actually gone down in the last 5 or 6 years, and I'll talk about why in a second. But monetary policy neutrality is when monetary policy is neither trying to be expansionary or restrictive. The reason neutrality has fallen in the last few years is because cuts in the cash rate have become less effective. So what I mean by that is the RBA's had to be more expansionary and cut the cash rate by even more to have their desired effects. And there's two reasons for that. So two reasons why the cash rate has to lower by even more now to have the same expansionary effects it had in the past. First thing is the difference between the cash rate and the market interest rate has widened, So the RBA has to lower their cash rate even more for the banks to pass on the same amount that they did in the past. So if the banks aren't passing it on, they've got to do bigger cash rate cuts. So eventually they'll pass some of it on. That's one reason. And the second reason is because households are in so much debt, further cuts haven't actually increased economic growth by much, because what's happening is because we're in hundreds and hundreds of thousands of debt, rather than people spending more money on other things when they get an interest rate cut, they'd be more inclined to just pay off more of their mortgage. And when they do that, it doesn't fuel the economic growth like it would if people are spending more. So the lower cash rate, the RBA lowering the cash rate is less effective because people are choosing to just pay off more of their mortgage, which is not having the stimulatory effects on growth and employment as it has in the past. So therefore, the RBA has to be even more expansionary to get to their expansionary stance, or loosen monetary policy even more. One, because the banks aren't passing it on, and two, because households are in so much debt that they're not really stimulating more spending when they do these rate cuts. This is basically just a graph showing the cash rate up until 2015. So you can see it's been falling over the last 4 or 5 years and has continued to fall past this graph. The real cash rate is basically the rate of interest. The cash rate minus the level of inflation. So we know inflation is around 2%, so that's why the real cash rate's around 0% towards the end. This bit here, the cash rate was actually lower than the level of inflation during that time, so we had a negative real cash rate. So in recent times, we've actually shifted from a restrictive stance where the cash rate was quite high before the GFC, and then we started to move to a more expansionary stance by 2009. We'll talk a little bit more about the actual process that occurred later on. Thank you.